European stocks are climbing while the US market is facing a decline. Some investors are selling their US-heavy ETFs and shifting to Europe. But is this a smart investment move or just another emotional reaction to short-term trends? In this video, we'll break it all down and see what makes the most sense for long-term investors like you. Right now, the S&P 500 is down about 8% from its peak, and small-cap stocks have dropped even more. Meanwhile, the European stocks are performing well. The Stoxx 600 index is up about 8% in the last few months, and Euro Stoxx 50 is up in double digits. So what's driving this trend? One major factor is the slowdown in the US economy. GDP growth forecasts have been cut, and there's uncertainty around tariffs and overall what's happening in the White House and all the policy changes. Meanwhile, European markets have lower valuations, making them look like a safer bet right now. But why European investors are moving away from US? Well, there's at least three main reasons. First of all, political and economical concerns. Imagine you're an investor in 2008, watching the financial crisis unfold. Uncertainty breeds fear, and today similar concerns exist. With trade war tension, shifting policies, and increased amount of changes from the White House, some investors worry that the US economy is heading for some turbulence. The fear is that these risks could impact stock prices, making a shift towards European markets seems sort of like a safe bet. Second, supporting European markets. Let's say you live in Netherlands, Spain, France, or Germany, or overall in Europe, and you hear about increased defense spending across Europe. You see new contracts being signed for European-made fighter jets and tanks. Some investors feel that putting their money into European stocks, especially defense and industrial companies, not only aligns with their regional interest, but also capitalizes on potential growth. Third one, fears of overvaluation. Picture the US stock market as a long-running party. It's been going strong for years, with tech giants like Apple, Nvidia, Microsoft driving the music. But some investors think the party is getting too wild. Valuations are high, and they fear a market correction is due. So they start leaving early, shifting to European stocks with lower price-to-earnings ratios, hoping to avoid the potential crash. But does market timing really work? We've seen this before. Investors react to short-term fears and sell only to miss out on major gains. If you had sold US stocks in 2016 because of political uncertainty, you would have missed one of the best performing periods for the S&P 500. Emotional investing rarely pays off. Imagine this. An investor panics during a market dip, sells everything, and waits for the perfect time to re-enter. But by the time they muster the confidence to buy again, prices have already rebounded, meaning they've locked in the losses and missed out on the gains. This cycle repeats itself for countless investors who let emotions guide their decisions. The key takeaway: a long-term, disciplined strategy, one that ignores short-term noise, consistently beats reactionary moves. So if you are rethinking your portfolio, what are your options? Well, let's start with US-heavy ETFs. S&P 500 or Nasdaq. The US market has been the epicenter of innovation for decades. Companies like Apple, Microsoft, and Nvidia have consistently pushed the boundaries of technology and growth, making US-heavy ETFs attractive for long-term investors. However, the concentration in big tech is a double-edged sword. Think about the dot-com bubble of the early 2000s. Tech stocks soared only to come crashing down. While today's market is different, high valuations mean any economic downturn or sector slowdown could disproportionately impact those ETFs. Additionally, US companies dominate global indices, making it quite hard for investors to truly diversify without looking beyond the S&P 500 and Nasdaq. This raises the question: is too much exposure to the US a risk? Now, second choice is global ETFs. These ETFs are designed for investors who don't want to bet on a single country or region. Imagine standing at a buffet. Rather than filling your plate with just one dish, you sample a little bit of everything. Similarly, global ETFs spread investments across multiple markets, reducing country-specific risks. The advantage is clear: you're not solely dependent on the performance of the US, Europe, or emerging markets. If one region underperforms, another might pick up the slack. However, despite their global branding, many of these ETFs still have heavy US exposure, typically around 60%. Why? Because the US market is the largest and most dominant in the world, making it difficult to fully escape its influence. A third choice could be European ETFs. Stoxx 600, Euro Stoxx 50, DAX, and any other specific sector ETFs. European stocks have been trading at lower valuations compared to their US counterparts for years. This makes them attractive for value investors who believe that buying stocks at lower prices relative to their earnings will lead to better long term returns. Think of it like shopping during a discount season. Many high quality companies in Europe trade at lower multiples than their US peers. A key strength of European markets lies in their strong industrial and defense sectors. Imagine the backbone of Europe's economy. Major industrial players like Siemens or Airbus or defense contractors benefiting from increased military spending across the continent. With geopolitical tensions rising, European governments are ramping up defensive budgets, which could in turn benefit companies in this space. However, historically, European stocks have lagged behind the US in terms of long term growth. While the US is home to major tech disruptors like Apple, Google, and Amazon, Europe have fewer high growth technology companies. As a result, European indices have often underperformed the S&P 500 over the long periods. Investors considering European ETFs should weigh stability and value against the growth potential that US markets have historically provided. What's the case for European defense stocks? Some investors are shifting their money into European defense stocks, believing that rising defense budgets will create long term growth. Is this a genuine investment opportunity or just a specific hype? Now, defense spending is increasing, but valuations on those stocks are also climbing fast. If you're considering this move, make sure you're investing based on fundamentals, not just following a trend. If you jump in something where valuations are already at super high level, regardless of budget increase, it will take way too long to see the returns. Now, should you worry about US political instability? Trade wars and constant policy changes always create uncertainty. History has shown that markets adapt. What's more important than politics? Company fundamentals and economic cycles. If you are a long term investor, these short term issues shouldn't drive your decision making. Now, the question rises how to be smart about adjusting your portfolio. Instead of making emotional decisions, consider these practical strategies. First of all, you can kick off with a globally diversified ETF. Avoid trying to guess which region will perform best by spreading your risk. Second of all, a core satellite approach. Use a broad ETF like S&P 500, for example, which I like a lot, as your main foundation, then selectively add sectors or regional ETFs for specific opportunities. And third part is regular rebalancing. Instead of reacting to headlines, adjust your allocations based on performance over time. Now, when choosing an ETF, focus on the expense ratio, liquidity, and how closely it tracks its index. So, to answer, should you sell your US ETFs and shift to Europe? History tells us that market timing is risky and rarely works in the long run. If you believe in diversification, a global approach still makes sense. European stocks may offer opportunities, but don't let short term market trends dictate your entire investment plan. Question back to you. What do you think? Are you staying global or tilting towards Europe? Let's discuss in the comment section.